Welcome to P2 Corporate Reporting. In this section, we are going to look at reporting employee benefits in corporate reports. The standard that guides us when recording employee benefits is IAS 19, Employee Benefits. This is a new standard and you won't have seen it before in your studies. Employee benefits. Employers pay their employees for their work, in short, and long-term benefits. You are probably familiar with receiving payment called a salary for your job. Salaries are examples of short-term benefits. When recording employee benefits, they should be recorded in the financial statements when they are earned, not paid. So, for example, for a company with a financial year end of 31st of December 2010, and they pay their staff their December salary on the 1st of January 2011 instead. The December salary must be recorded in the 2010 financial statements, the year it was earned. Other short-term employee benefits include sick leave, holiday pay, and bonuses. All need to be recognised in the year they are earned. Now, what about employee profit share schemes? The company needs to recognise this expense and reliably estimate the cost when their obligation to make this payment arises. Long-term benefits. So that's the short-term benefits. What about the long-term ones? Many of these are actually for when an employee finishes working with an organisation. These are usually referred to as pensions and will provide an income for their retired workers. There are two types: defined contribution plan and defined benefit plan. So what are these? A defined contribution plan is where an employer pays an agreed amount into a pension fund for an employee. That is where their obligations end. How are they recorded in the financial statements? The contributions are expensed through the statement of profit and loss. If the payments are unpaid or not due within 12 months after the reporting period when the employee has worked, earning this benefit, the contributions are discounted to their present value. A defined benefit plan. This plan obliges the company to pay a defined income to their past employees. For example, it could be 75% of their final salary, etc. Defined benefit plans are very attractive for employees as their benefits are specifically defined, unlike the defined contribution, which is dependent on the pension fund's performance. However, a defined benefit scheme is expensive and places an obligation on employers to their past employees. Therefore, they are becoming less common. But you still need to be able to account for them. A defined benefit plan is a fund that the company invests on assets, hoping to make a return to maintain the income of its retired employees. Now, from your studies so far, you should be well aware that assets can go up as well as down in value. What does this mean for our defined benefit fund? It means some years there will be a surplus and others a deficit, which is recognised in the statement of profit and loss. You are going to hear the terms vested and unvested. When we talk about employee benefits, unvested means that the ownership hasn't transferred to the employee, and vested means it has. There are some new terms that you need to become familiar with when accounting for defined benefit pension funds. Expected return on the plan's assets. The expected return on the plan's assets is now based on the return from AA bonds. The assets return is based on AA bond return because it is more transparent and consistent. It also encourages firms to invest in more secure investments. As I said earlier, the fund will have a surplus or a deficit. If it has a surplus, then it has more assets than liabilities. In this situation, it will have net interest received. If it has a deficit, it will have more liabilities than assets, and it will have net interest paid. Actuarial losses and gains will also need to be accounted for. What are these? These are recognised in the OCI, and the difference between what was expected or estimated values and actual values. Current service cost. This reflects an increase in the pension liability due to employee benefits earned in the year. This is expensed through the income statement and added to the liability. Past service costs incur when the benefits of the plan change, either by improving or reducing. These should be immediately recognised in the income statement. To increase the benefits of the plan, debit income statement, credit pension liability. A plan curtailment or settlement is when there is a reduction in benefits or number of employees in the pension. Contributions to the pension fund. This is the money the organisation puts into the pension. Benefits paid. These are the payments from the pension fund to their beneficiaries. The pension liability is reduced, however, so is the pension fund. There is a lot of new information here, so let's do an example. JP is a multinational with a defined benefit pension scheme for its employees. The scheme has been in place for over 10 years. Here are the details for the year ended 20x7. Pension fund asset carried forward $1,000. Pension fund liability carried forward $1,200. Current service cost $200. Expected rate of return 10%. Discount rate 10%. Contributions paid in 20x7 $100. Benefits paid in 20x7 $60. Actuarial carried forward for the pension fund asset $1,100. Actuarial carried forward pension fund liability $1,300. JP wants to know how to record this in their financial statements for the year ended 20x7. So let's start. The pension fund assets and liabilities carried forward are just what they say they are. They're carried forward from the previous year's financial statements. And we need to find this year's, so they are our starting point. The current service cost of $200. So this needs to be expensed in the year it was earned. Remember, this is access to a pension payment that the employees earned in the year. So it is recognised in the year. Debit income statement $200, credit pension liability $200. Next we have the current return on assets of 10%. Remember what I said earlier. This rate of return is based on AA rated bonds. This is the return on the plan's assets, which are $1,000. This is the pension asset brought forward at 10%, which is $100, equals $100. Therefore, we debit the pension asset $100, credit the interest $100. Now we have looked at the assets. What about the liability? This is sometimes referred to as the interest cost or the unwinding of a discount. The liability carried forward was $1,200. At 10% equals $120. Debit interest $120, credit pension liability. So far, so good. $100 of contributions were paid. So this is recognized as follows: debit pensions asset, $100, credit cash, $100. And $60 of benefits were paid out of the scheme. To recognize these, we debit pension liability, $60, reducing the liability, credit pension asset, and reducing the pension asset. So, how do we calculate the figure for the statement of financial position? And what gain goes through the OCI? Now that we have made all the journals, we go back and find the ones that impacted on the pension fund asset and liabilities. First, the pension fund asset. Remember, it is an asset on the balance sheet, so a debit increases it and a credit decreases it. So the pension fund asset carried forward is $100. Debit the pension asset, $100. Debit pension asset again, it's $100. And credit pension asset by $60. The total is $1,140. And the pension liability, remember, to increase it, we credit it, and reduce it, we debit it. Pension fund liability carried forward, $1,200. Credit pension liability by $200, credit again by $120, and the debit the pension liability by $60. The total is $1,460. So from the journals we posted, we know that the pension fund assets are expected to have increased from their $1,000 opening balance to $1,140. So the assets are expected to increase by $140. And the pension fund liabilities are expected to increase by $260 in the year. Netted off, the journals posted result in $120 expected increase in the pension liability. Now, what did happen? What did happen is reflected in the actuarial results. From the question, we know that the actuarial value for the year was $1,100 for the pension fund asset, and the actuarial carried forward of the pension fund liability was $1,300. Therefore, the actuarial gain on the assets was $100 and on the liabilities was also $100. So the assets are worth less than we expected, $40 less. And the liabilities are $160 less than expected. So the net result is a gain of $120, i.e. 160 minus 40 is 120. A reduction in liabilities is a gain. Net difference of $120 is the actuarial gain. This gain is reported through the OCI. Based on the journals posted, the balance sheet will show a liability of $320. Less the remeasurement of $120 brings the liability to $200. Credit OCI $120, debit pension liability $120. Look over at this table before you move on, because it shows where the figures for recording the journals came from. In the question, you saw the plan's assets and liabilities values carried forward. IAS 19 has an assets ceiling, which, as you probably can guess, it is a limit or a ceiling on the valuation of the assets. The ceiling means any asset on the balance sheet recognised in respect of the defined benefit pension scheme is the lower of either any surplus in the fund or the asset ceiling, which is the present value of any economic benefits available in the form of refunds from the plan or reductions in future contributions to the plan. Why does the ceiling exist? Imagine if there is a defined benefit scheme and normally staff retire at 55, and yet for whatever reason staff begin to retire at 60. This means that the benefits are deferred for a longer period or unvested. If the fund was measured, it would be misleading because it would appear the fund is doing better than it was or making more gains, but in fact, it is because the benefits haven't vested. Thank you.